Okay, in this video we're going to be looking at the limitations of GDP statistics. So why GDP and GDP per capita are often an ineffective measure of our living standards. And sometimes these factors will lead to GDP overestimating our living standards, and some of these factors will lead to GDP underestimating our living standards. So the first one is GDP and GDP per capita do not take into account non-market activity. Non-market activity is non-market production, which basically means that it's not counted in our tax and it's not normal production that occurs in the economy to generate an income. So non-market production is excluded as it is too difficult to calculate and therefore underestimates our living standards. There are people that are earning money and contributing to production that aren't being accounted for in our GDP statistics. Whenever you talk about non-market activity as an answer, as one of the limitations, don't talk about these individually, talk about them all as one. So if you got this question, you would say one limitation of GDP statistics is that it doesn't include non-market activity and therefore underestimates our true living standards. Non-market activity includes illegal production, so therefore like any selling of drugs, drug dealers again don't pay tax, selling burnt CDs might be included in that kind of production as well. It includes the cash economy, so anything that's sold for cash that's not declared in tax. Often things that you buy in cash will be declared in tax when you go to most restaurants, but there are dodgy restaurants in like Crowe and stuff that don't declare it in cash, that wouldn't be included in our GDP. It doesn't include household activity, so if you do the ironing or the washing, or if you get a tree lopper to your house and then you cut up all the wood, all that stuff, the tree lopper would be included, but not you cutting up your own wood and for firewood. Any gardening you do or housekeeping or any do-it-yourself work would not be included as part of our GDP. Again, back to that tree lopper, if the tree lopper asked you to pay him in cash so he didn't have to declare it, that wouldn't be included as well. So these all underestimate our living standards, and you need to talk about them as all one thing if you're talking about a limitation, because it'll be worth 2 marks. Another limitation of living standards is that it estimates some production. So the value of some production included in GDP statistics needs to be estimated, as it is not usually marketed or sold in normal ways. Okay, and that can either lead to an overestimation or underestimation of living standards. So some examples: farm output consumed on the farm. So if I own a farm and I milk my cows and unfortunately slaughter some of my cows to generate meat, but we consume some of that on the farm. So for dinner, if we're drinking milk, we're not actually selling it in normal ways. That they actually estimate the amount that we consume on our own farms, if I was an owner of a farm, and estimate that amount in our GDP as well. So it's not included, it's just estimated. And same with the net rental value of accommodation provided by houses to their owners. So that idea of imputed rent, which we talked about in the past, that figure gets estimated as well. So if you live in your own house, it doesn't get excluded, don't say that, it gets estimated. And that's a limitation. And the other thing, there's some government services that are provided free of charge. So things like ambulance services, policemen, firemen, their services are basically estimated as well. The cost of providing government services free of charge, you estimate the value that they provide and include that in GST and GDP as well, but it is estimated. The other problem with GDP is it doesn't take into account quality changes. So for example, if we are producing a computer that looks like this and selling it for $1,000, and then the next year we're producing an Apple Mac that's 3 times as good as this, but still sells for $1,000, okay, it's a much better computer, it's improving people's living standards, but that's not reflected in growth because both of them will contribute $1,000 to GDP. Okay, same with DVD players. If we look back 10 years ago, this DVD player probably sold for $1,000. Okay, if that was in the shops now, good $1,000. If it was in the shops now, it probably sells for $150. So it's actually showing that our GDP is reduced because the value has gone down. But and again, and when we use it in real terms, then it would be exactly the same. But the quality of the product is still better. So the quality of the product is better, but that's not reflected in our GDP. Okay, so quality often improves while prices stay the same, and therefore that doesn't lead to increased real GDP because we calculate it. We don't factor in the quality of the product. Using the chain price index, I wouldn't refer to this one unless you have to, but when we use market prices or real GDP, we have an index to convert products to use constant prices or to get rid of inflation. But the process of converting GDP at current prices to constant prices, or nominal GDP to real GDP, can often be a little bit inaccurate. and therefore that's one limitation. Other limitations, it doesn't take any into account the distribution of income. So even GDP per capita can be, say, 500,000 for a country, but someone could be on $1 million and the second person be on $2. So it doesn't take into any account of how the income is shared amongst society. It's a very common one that people will talk about. Another one, which I'll talk about quickly, international comparisons. Countries use different figures and statistics to get to their GDP, which makes it inaccurate to compare one country from another just by based on what's included. Some countries have a much bigger black market, but just the figures that firms use to calculate their GDP can be inaccurate. Okay, another one that's very popular is GDP does not account for non-material living standards. Okay, it doesn't take into account the level of pollution, stress, that we might be working longer hours, that we might be depleting our resources. None of that thing will be included in GDP. So it doesn't take into account that some bad things basically could be happening, and therefore that can lead to GDP overestimating our living standards. Because we're not as well off as we think, even though GDP growth might be 10%, we've just destroyed a forest. Or we're working for twice as long. The other thing that GDP does is that GDP does not account for rework and corrective production, or those transactions that detract from our welfare. So what I mean by that is, if we have a cyclone or a natural disaster, that generally leads to an increase in aggregate demand. It leads to increased infrastructure spending to repair all the roads or all the infrastructure, and generally countries will experience an increase in their GDP when they experience one of these issues. So for example, New Zealand, when they had the earthquake, they experienced an increase in their GDP because they had to spend so much money on rework, and that generated production and jobs and employment. Same with psychiatrists. If everyone's going to see a psychiatrist, that's going to boost our GDP, but it's kind of about corrective work. It's not necessarily boosting our living standards if everybody's going to see a psychiatrist, but they generate an income, so it boosts our GDP. Another example, if I was to go to Safeway and knock off all the milk over on the dairy aisle, 3 people would have to come and clean that up, and they might have to get someone else in for the night. That would boost GDP, but again, it's corrective work that can reduce our living standards. So that can lead to GDP overestimating our living standards. And finally, this one's a little bit confusing, but there's a thing with the terms of trade. So basically, if the terms of trade goes up, it basically means that export prices are going up. So we might not be selling any more, but the price is higher. So we might have been selling our export for, say, $20, and then we start selling them for $100. But if we're still selling the same amount, say if we're still say 1 million tons of coal to China, it won't be reflected in our real GDP because we take out the impacts of price changes. So real GDP does not record the higher value we are getting for exports because export volumes remain the same when our terms of trade increases. And that's kind of the opposite at the moment. The terms of trade's going down, so our real GDP should actually be falling by more, but it doesn't count because it's all about price. So therefore, when we calculate real GDP, we remove the impact of higher prices, and therefore even though gross national income will increase, real GDP will not increase due to higher export prices. Okay, so gross national income can be more accurate in this case. Just the other thing with the terms of trade is that if the terms of trade goes up, generally nominal GDP will go up by a lot more than real GDP because the prices are going up.